No matter your age, your plan for retirement can start today. From the News Channel 5 network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. Going to be covering a few things today that I think you're going to find interesting and helpful. Some of those to do with behavioral investing. And this is one, there's been a number of books written about it. Animal Spirits is a good one. And also in the report I'm going to share with you today, this one is called Quantitative Analysis of Investor Behavior by an independent group called Dalbar. And what we want to see, or what you will see with this, is showing basically how much investors underperform the market when they're due to kind of bad habits. You know, one of those we've talked about many times as far as on the show, different what these habits can be. One being market timing. Trying to time the market. This year has been one of those that's shown up. We've seen underperformance as far as the average investor receiving less than half, even in many instances, what the market would have provided them had they just stayed disciplined and stayed on course. But we get fearful, right? And fear can drive behaviors, and just as fear and greed, those two things, as Warren Buffett has been famously quoted as saying, you know, be fearful when others are greedy, and greedy when others are fearful. When the market's going down, the tendency is to want to, be fearful that it's not going to come back, or that I'm going to lose money and never regain it, or it'll take many years to recover. And not to say that can't be the case, but if you're properly allocated in your investments, then this will help protect you in those downturns, and you'll recover faster. And if your overall planning takes into account the income you're going to need in retirement, so that in that let's say, in 5-year increments, that we would have a 5-year plan for income that makes sure your income stays steady, whatever's going on in the market. And your investment plan is going to reduce down that volatility and recover faster from downturns. So again, it's all about good planning. And unfortunately, most investors get a lot less return from their investments due to these bad habits. Now, this is an example. Since 1984, according to Dalbar, 70% of average investor underperformance occurred during only 10 key periods in which investors withdrew their investments during periods of market crises, in other words, bear markets. And of those 10 most severe cases of underperformance, 8 of those would have produced better returns for the average investor just 1 year later if they had taken no action and just held on to their investments. See, this is one of the things when it comes to investing, is first off, making sure you're invested properly. So if you're just kind of winging it and checking off the boxes, looking at your 401k as an example and saying, well, I'm going to, see what these funds seem to have good numbers, I'll just put it in there, and not recognizing you may be investing in many of the same stocks, even though they're different mutual funds. And so you can have a lot of overlap. You can have a lot of funds, or a lot more risk added to your portfolio, even though these seem to be doing well. And one of the reasons is, as an example, over the last 10 years, large caps, the large companies, have done way better than small companies. Now, normally that's going to balance out, and normally, if you look over a longer period, like the last 20 years, small companies will outperform larger companies. So there's a bigger risk with those, and typically a bigger reward. And there are other factors here, but other examples of that, not just small and large cap, growth and value, there's others. Here's the key, is that we put them all together, right? Because we don't know which asset category is going to be the one having the nice run, and we don't know how long it might last. So what we found works best is that we blend together the proper asset allocation to protect you in any number of different market conditions, and again, reduce volatility while giving you the market return that you're seeking. This is how the smart money invests. In my book, one of the things that I talk about in that chapter, of course, is modern portfolio theory and how to use that to your advantage. What we're going to get in today is a bunch of different things that here at the beginning I want to talk to you a little bit about this behavioral part, because there's another piece that comes into play that was kind of interesting, and that is the piece of the virus that we're having this year. All right, so this year the markets have been affected in a very negative way, and the reason for that, of course, the pandemic, the effects of that, starting back in February 19 is when the market peaked, and then by March 23rd it had hit its bottom, and then it has basically gone up since then. In fact, on March 24th alone it went up 12%. So we've recovered from all of that, basically the shortest bear market in history. However, does that mean we've got an election coming up? So there's another risk, if you will, as far as volatility in that goes. So this is a good time again to take a look at what you're invested in, check your asset allocation, make sure that you understand what you're investing in, and if you don't, get some help with that. And one of the things is making sure you've got good, strong funds to invest in. And this is one of the things when it comes to investing. Most of us, when we're investing in the stock market, some of us have individual stocks and maybe a blend of individual stocks, mutual funds, exchange-traded funds, and the like. The mutual fund industry is one of those areas that has grown dramatically basically, if I came across this research piece from the Investment Company Institute, and one of the things it talks about was back in 1959, I don't know if you can see this, but in 1959, am I holding that up in the right place, Taylor? In 1959, the mutual fund industry had only $21 billion in it, and it represented about 4% of our GDP back then. The other thing that was kind of interesting, that 35% of mutual fund owning households identified retirement as the primary reason for investing in mutual funds. Again, 1959, so this is 60 years ago. The median age of mutual fund owning households was age 55. Now let's take a look. By the way, in my book I talked about in 1980 that the mutual fund industry at that time, there was about, let's see, what did I have? It was only 564 mutual funds around back in 1980. Compare that to today, where, and just talking U.S., you've got about almost 17,000 mutual funds, closed-end funds, not counting, or excuse me, open-end funds rather, and that's not counting other ETFs and other things that are, well, actually, if you take in closed-end funds, open-end funds, exchange-traded funds, and another is unit investment trusts, all are forms of funds, if you will, you've got about 16,000 different funds. So think about that. From 1980 to now, so over the last 40 years, we've gone from 564 funds to 16,000 funds. And if we look worldwide, it's actually over 100,000 funds. So here's another piece of that. If we look at the amount of money today, remember it was $21 billion in 59. And back in 1980, it was 135 billion. So think of that. It's about 6 times, 7 times almost as much. But today, it's $26 trillion in money invested in total net assets of registered investment companies. And it represents 120% of GDP compared to 4% before. Huge change. And part of that is how we invest. The reason that's the change is because of our retirement system has also changed, especially over the last 40 years since 1980. So mutual fund ownership households that identified retirement went from 35%, it more than doubled at 73%, and the median age is a little lower at 51. We invest in the market. So this is the other part. I've got some slides I'll show you. One of the things with these slides is to show a little bit about what's happening with the effect that the COVID is having on our behavior. Okay, so just like with the fear of market volatility causes us to sometimes many investors to make bad choices, and their account suffer as a result, cutting their returns down dramatically over developing that good plan, staying disciplined over the long term. All right, so let's take a look. Let's see, where are they at? Here we go. So on the first slide, what have we got there, Taylor? See if I can see it. I may need it on the monitor here so I can see it as well. So let's see here. What are we seeing is that we have people that are investing in the market in such a way, their behaviors mainly driven. This was, by the way, put out by Franklin Templeton and Gallup, and it showed the share of how people have a misperception of the dangers of COVID in terms of what it means in terms of their investments, as well as how they make decisions about just everyday life. So this is one of the things that these misperceptions, according to this study by, again, Franklin Templeton and Gallup, shows that people are, due to the media and the politicization of the politicking of the virus that we've got now. Of course, it's an election year, so everything becomes politicized, and this is one of the downsides, is it causes people to even more not see what the facts are. So an example was used in this one chart I'm looking at here, and I can't see, Taylor, we've got charts up yet? I'll tell you what, let's take a break, and then when we come back, we'll get these put together so we make sure that we can go over them. There we go, good. So we'll go ahead and take a break. When we come back, I'll dive into these charts in this study, because I want you to understand what this might mean for you, and also to give you the truth, the straight facts, based on, again, what they're showing, and how important it is to have that. Just like with investing, if you have misperceptions of how the stock market works, as an example, it could set you up for a lot less money over your lifetime, and a lot less, possibly even the risk of running out of money. But we'll get into that in more detail when we return. Join me here. We'll be right back on the Retirement Report.